From New York City, for our viewers worldwide, I'm Katie Greifeld, in for Jonathan Farrow. Bloomberg Real Yield starts right now. Coming up, still fighting the Fed on 2023 rate cuts. A December surprise from the Bank of Japan and bond issuers planning a New Year's blitz. We begin with the big issue, closing out a messy year for markets.
The volatility to start the year.
It's been a pretty volatile time.
We're seeing that volatility play out.
We have had 10-year Treasury yields break 4%.
Inflation is still elevated.
The biggest factor this year has been man-made volatility.
Whether it's fixed income, equities, commodities, currencies.
We have a war, we have Federal Reserve, tightening rates. We have all types of things going on in the oil market that are beyond anybody's control.
There's another shoe that has to drop, and that is the economy.
We'll start to see some disappointment maybe as we move into 2023.
What can go right in 2023?
We don't think it's going to be necessarily a year of robustness.
There's so much pessimism.
This recovery isn't going to be easy.
Joining us now to discuss, we have PGIM's Michael Collins, Aberdeen's Luke Hickmore, and Troy Gayeski of FS Investments. And Troy, you heard it there. There's a lot of uncertainty, a lot of pain priced into the markets next year. And that was the common denominator across markets this year, especially in fixed income. Does 2023 look any better from your vantage point?
Well, on a relative basis, you're certainly not going to have nearly as much pain in the Barclays Ag. We still think the combination of a Fed committed to crush inflation and taking the front end at least 5 to 5.25, as well as the fact that QT is still simmering behind the scenes, will lead to one more higher high in yields. We'd expect the 10-year to break through its more recent high on 4.25. But reasonable people can disagree on that. The bottom line is you don't have as egregious risk reward as you did coming into this year, where fixed income was the definition of return-free risk. You do have some protection in the event that the economy slips into a recession faster than we think. So not as much downside, certainly no great upside, not egregiously bad risk reward, but it's certainly not a place that you want to reach out for duration and take that risk of higher yields in the short term.
All right, not looking at duration yet necessarily, but Luke, Troy brings up the Fed's fight to really crush inflation here. And all my conversations about what the Fed is going to do next year still hinging on what happens to inflation. And of course, there's still a lot of daylight left between 7% and between 2%. But have we passed the ceiling on CPI when you look at the past several months of data?
Well, apart from that being the graveyard of all predictions, saying we're past the peak of inflation, yes, we are past the peak of inflation. I think if you look at what's been happening to the gasoline prices coming down, Mish today pointed to people's expectations perhaps easing a little bit. We need to see the employment market cool down some as well, and wages perhaps cool down too. But it does seem to me that the demand push is maybe faltering off a little bit, and the cost push is definitely faltering off a bit. I think by the second half of this year, we are going to be getting very close to where the Fed wants us to be.
And does that include a recession? Because again, when you think about crushing inflation, when you think about taking the edge off the labor market, again, the Fed is working with really blunt tools here. Are you concerned that they're going to overdo it?
The Fed always overdoes it. Every single tightening cycle leads to a recession. Well, pretty much every single tightening cycle. I think, yes, we get one. 65% of your economic survey respondents on Bloomberg are saying a recession's coming. I'm just shocked that's not a lot more than that. I see a recession baked on, really, for next year. And it's probably going to be Q2, and it's probably not going to be a drawn-out one like we're likely to see in the UK, but it is coming.
And Michael, let's bring you in here and let's stick with the idea that a recession is coming, because you look across Wall Street and you can quibble over the magnitude, over the severity, but it seems like the consensus is for a recession next year. Is that your view as well?
Well, the magnitude and the severity is really the important point, Katie, right? I mean, I think it's kind of a foregone conclusion you'll have some kind of soft landing or maybe mild recession next year. And that's pretty much priced into risk assets. What is not priced in is something much worse, where the unemployment rate doesn't just go from 3.7 to 5, it goes up to 6, right? And to Luke's point, the Fed generally has done a pretty bad job at engineering these soft landings. They have done it on a couple of occasions. They did it in the mid-90s when they hiked the funds rate 300 basis points. Then they moderated it pretty quickly and bounced it around, and the economy kind of averted the hard landing. And that could very well be the case. I'm much more in the mild recession / soft landing camp, just because the fundamentals of the economy, the fundamentals of companies and of industries are actually much better than they've been going into some of these more existential, crises we've become accustomed to.
And Michael, you're right that we are missing the important part of the conversation is how bad that recession will be. But it seems like because of that recession consensus, again, the details were a little light on, but because of that, maybe that's why you're seeing some cuts being priced in to the end of next year. That's very different from what the Fed's latest dot plot is showing. And Morgan Stanley's Jim Caron says that's a mistake. He says that the markets have it all wrong. The Fed is committed to taming inflation. Again, that's the view of Morgan Stanley's Jim Caron. Let's take a listen.
I don't believe the hiking cycles are sufficiently priced in. I think what's priced is quite the opposite. I think what's priced is that people expect rates to come down. And I think we need to listen to what these central bankers are saying, that they are worried about inflation.
So, Michael, there's a bit of a fight brewing there. Again, when it comes to the back half of 2023, the Fed is saying one thing, the markets are pricing another. Who wins out when it comes to rate cuts?
Yeah, I mean, I think the markets will win out, right? I mean, there's this game of chicken going on, to your point, Katie, right? The markets know the Fed has to talk tough. The Fed does not want financial conditions to ease too much. They don't want the markets to take off and demand to continue to be robust and inflation be sticky. So they have to talk tough. But the markets kind of wink at them and say, we get it. You're going to try to get to 5% and keep it there. But we all know that inflation is coming down. We all know growth is coming down. And we all know you're going to blink. And you're going to cut probably a couple, 50 basis points next year and maybe another 150 in 24, which is really where the bigger delta is between the Fed's dot plot, which expects the funds rate to be at 4% at the end of 24, and the market is 100 basis points lower, right? So that's really where the rubber hits the road.
And Troy, let's game plan this out a little bit. If a recession is really on everyone's bingo card for 2023, is that accompanied by sort of a downdrift in inflation, maybe getting back not to 2%, but pretty close to that target? And if so, I mean, is that just bullish on bonds? Is that a green light?
Well, first of all, we'd say, remember, that with regard to financial condition tightening, the Fed continues to want tighter financial conditions, which include higher bond yields. And no disrespect to Michael, but we do think that they're going to be very reluctant to cut into the next downturn until they're crystal clear that their 2% core is within sight. And that's probably going to be a lot harder to get inflation from 4 to 2 or 3 to 2 than it's been for it to roll off the highs recently. Now, in terms of scenario planning, look, I think the number one scenario you have to plan for in broader markets is that with tightening continuing, as well as the balance sheet draining and money supply being drained out of the system, it's more than likely that we make a lower low in all risk assets. And ultimately, remember, we will get out of this inflationary spiral. The unfortunate thing is that the price we will pay for it is a recession. And we just don't think equities or more speculative credit is fully pricing that in yet.
And I think Jerome Powell would be happy to hear you say that it's still unlikely that we get rate cuts of some form next year. But what would need to happen? What would shift you to maybe more in Michael's camp that we could actually see the Fed ease next year?
Yeah, so if you look at a diagram of where right tails on probability distributions overlap, it's that A, inflation comes down faster than expectations. We all know it's coming down, just a question of speed. B, that allows the Fed to back off and maybe only take the front end to 5.25 and go no further. C, they continue to be cautious in the speed which they drain the balance sheet. And then lastly, we don't have the degree of margin compression or profit margin compression in corporate America. So if all of those things come together, right, then there is a possibility in a deeper recession that the Fed's cutting in Q4 of next year. But that's really the soonest we can see it. If that's the case, then perhaps we only have peak to trough 30%-ish mark-to-market drawdown in the S&P. And again, yields have actually peaked at 4.25. We won't see that again. But from our standpoint, that's going to take a lot of right tail events in different probability distributions to achieve.
We have so much to dig into, but we probably should talk about the news of the week. Again, I was expecting a pretty quiet macro week, but the Bank of Japan caught markets off guard and then some with a shift in its bond yield policy. You have money managers betting on the central bank to maybe crack and finally cash in on that. Blue Bay Asset Management is sticking with short JGB positions, saying, quote, the genie is out of the bottle here. And Schroders seeing validation and doubling down, saying, quote, that the market will now pressure the BOJ. We are adding to our short position and building our position in the yen. This has more legs and we are on it. What a quote. And Luke, I want to bring that to you because obviously Japanese investors, they've been a little MIA from the Treasury market this year, but that group of investors is the largest class of foreign holders of U.S. bonds. And maybe it's a long-term issue, but down the road, if you have yields higher in Japan, maybe that class of investors staying home, does that worry you when it comes to the demand picture for treasuries?
I think that is going to play out over the next 6 months for sure. And there's a real risk here that I'd agree about being short 10-year JGBs. It feels this kind of 50 basis points band could easily spook the market to the point where we see quite a sharp sell-off into a 70, maybe even 100 basis points in the 10-year Japan. And even at that level, the relationship with the long end, which of course has been free to trade for a long time now, would still be at historical wide levels. So, if that happens and it starts to look attractive domestically, yeah, you could see some repatriation of funds, but it would take a lot. And it would also take the FX markets to shift around a bit as well. That kind of seems a bit tricky to do at the moment. The dollar's definitely be weakening. And if people start buying into that rate cut story in the second half of next year, we could see a weaker dollar. And again, that could lead to more repatriation into yen bonds too. So yeah, it's out there as a risk, but we're not there yet, I think, in terms of the relative value for Japanese domestic investors shifting out of treasuries.
Big ramifications for the currency market, big ramifications maybe for the bond market as well. Guys, we are just getting started. Mike Collins, Luke Hickmore, and Troy Gayeski, everyone is sticking with us. Up next, it's the auction block. Bond issuers planning a New Year's blitz after the slowest December in 15 years. That conversation coming up next. This is Real Yield on Bloomberg. This is Bloomberg Real Yield. I'm Katie Greifeld in for Jonathan Farrow, and it's time now for the auction block where we kick things off in Europe. Market-wide issuance falling 14% this year, total volume falling short of 1.5 trillion euros with a record 50 days, no bond sales. Over in the U.S., high-grade debt sales expected to hit $40 billion next month. Bond issuers are storming the market after the slowest December in 15 years. And there was no issuance this week in the U.S. junk bond market. It's a proper way to close out the slowest year since 2008. And sticking with credit, Tom Tzouras of Strategist revealing his outlook for the year ahead. Take a listen.
Really, the truth is we're looking at a very shallow recession and very shallow credit contraction in 2023. We do expect to see positive returns in investment grade credit in 2023. High yield is going to be a potentially different story because it's going to depend an awful lot on the types of credits, the industries, the management, because in high yield, you're always 4 quarters away from default, and you have to consider, will some of these names make it out of the recession alive?
Still with us now, Mike Collins, Luke Hickmore, and Troy Gayeski. And Michael, I want to start right there because high yield has outperformed, but the Tzouras view is that IG is the place to be. Where do you fall on that camp?
I mean, high yield has outperformed because, it has a much higher yield and spread, and default rates continue to be near record lows, Katie. They've been really, really muted, but it's all about what's going to happen, right? And default rates will increase next year. We know that. Whether they go from 1 to 2 or 3 or 4 or 5 or higher is really unknown, but they are going up. And typically, when default rates are going up, you don't want to be too early getting into high yield. So we're playing it pretty defensively in the riskier parts of the credit markets. I'm personally more concerned about the levered loan market, which is fundamentally in much worse shape than the U.S. high yield bond market. But generally speaking, stay away from some of the riskier credits until you get either a clear sign from the Fed or signs that the economy is bottoming.
Well, I mean, you bring up a good point that default rates at this point, they've been very, very low relative to history at this point where we are in the cycle. And Troy, I mean, Mike thinks that we're heading maybe for that rate to increase. To what degree, we're not sure yet. But what is your view on where corporate America is heading in terms of defaults? And how does that filter through to the riskier parts of the bond market?
Oh, yeah. So we share Michael's view in that, levered loans you don't want to touch with a 10-foot pole because they've barely gone down at all in price. And that's where you've seen the biggest credit degradation the last 10 years. They've benefited because they're floating rate, right? So income has gone up, but debt service coverage ratios have collapsed. So, from our standpoint, if you're going to move out on the efficient frontier and take more risk and credit, two areas you could focus on would either be BB CLOs or higher in the capital structure. I mean, single A's are yielding, 8-9% now, which is really unprecedented given the credit quality right now. There, you have real ample subordination to withstand an increase in defaults and levered loans, and you could still benefit from some yield pickup going forward. Two, if you segue over to even more higher quality areas, one of our favorite expressions right now is in interest-only strips on agency mortgage-backed securities, where you have really tremendous yield, not only because prepayments have collapsed because interest rates have gone up so much, but also because home prices have started to decline. So as home prices decline, it's very difficult for those that took out a mortgage the last 6 to 9 months to refi regardless of rate level, right? So even if rates go back down, it's very unusual for people to kick in more equity of their home in order to refinance. And because agency pass-through spreads have widened so much due to the Fed's QT, you can be long interest-only strips, which are negative duration, and then you buy back duration through agency pass-throughs, which sets up for a very nice 10 to 15% positive carry with no duration that's very non-correlated to other assets. So we agree with Michael, stay in the more quality areas of credit, shun levered loans. If you're going to take that type of risk, look at CLOs, which have much more subordination. But there are other opportunities in vast fixed income markets that you don't have duration risk and you don't have that degree of credit risk.
All right, not reaching for risk here. Well, let's bring you a view from BNP Paribas because they're looking for another year of surprises, writing, quote, yields are the best they have been in decades, but it's quite possible we widen again at the start of next year. We've had very sharp, unexpected moves, and this will continue. And Luke, let's talk about that a little bit because I want to talk about spreads, how they typically perform in a recession, thinking about high yield specifically. 800s, 900s, that's sort of the benchmark that I've been socialized to expect. But the sort of downturn that we could be heading into, how do the riskier parts of the high yield market, for example, behave in that environment?
Yeah, the thing I suppose that's different right now is we've got inflation, which means a recession is still nominal growth. Once we get that inflation down, nominal growth comes under risk. And 2024, we could see a nominal recession with a real growth. That's a horrible situation for high yield. And it's those kind of markets that are going to look forward to that kind of area. And we could easily see movements into the 700 or 800 over for a lot of high yield credits in the single B and triple C kind of area. Probably non-financial rather than financial. As you know, most of the financial stuff in high yield is the lower parts of the capital structure, which actually we still quite like a lot here, bearing in mind banks are in such a good position going into the recession. But that high yield and the market looking forward to that is really a first half next year story. So, you know, in Europe, we've been shorting crossover and starting to build up a position there. And we'll probably be doing that more and more as we go through the early part of next year, trying to protect some of those spread widening moves that we could see.
And Mike, just quickly, Luke likes financials, 20 seconds or so. What sectors appeal to you right now?
Yeah, I mean, we actually like some of the more cyclical, traditionally cyclical sectors within the higher quality part of the high yield market or the investment grade. I mean, you look at the financials, you look at commodities, energy companies, even autos and home builders, Katie, have been killed, but they're cheap and they're in a much different financial position than they've been going into past downturns. So there's some value in those areas as well.
Mike Collins, Luke Hickmore, and Troy Gayeski, everyone is sticking with us. Still ahead, it's the final spread. The week ahead, U.S. jobless claims stealing the spotlight amid a holiday-shortened week. That conversation up next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. Time now for the final spread. The week ahead, coming up, markets closed across Europe and the U.S. on Monday in observance of the Christmas holiday. Then wholesale inventories coming on Tuesday. We have U.S. jobless claims and the ECB publishing its economic bulletin on Thursday. And finally, U.S. bond markets closing early on Friday, 2 p.m. Eastern. But before we get there, it's the rapid fire round. 3 questions, 3 quick answers. Troy, I'm going to start with you. 10-year Treasury yields, 3% or 4% first?
4%.
Mike.
3.
Luke.
4.
Troy, credit spreads, wider or tighter this time next year?
Wider.
Mike.
Wider.
Luke.
Tighter Europe, wider US?
I'm talking about the U.S. here. Okay.
Wider.
Okay. All right. Last question. Troy, yes or no, does the Bank of Japan hike in 2023?
Yes.
Mike.
Sure.
Luke.
Have to.
All right. Good stuff. A lot of consensus there. My thanks to Mike Collins, Luke Hickmore, and Troy Gayeski. That is going to do it for Bloomberg Real Yield this year. Thank you so much for tuning in. Again, this was Bloomberg Real Yield, and this is Bloomberg.